All right. Thank you very much for joining us today on our webinar. It's 5 financial tasks to scratch off while you work from home. My name is Lars Phillips. I'm joined by my colleague, Alex Krider. Dave Welty, the managing director of the firm, he wanted to participate in today's webinar, but he did have an important client item that he had to attend to. As you can assume, there's been a lot of volatility in the markets, and there's a lot of little things that need to be done. So it's just going to be Alex and I today, but we're going to talk through the 5 financial tasks to really scratch off your bucket list while you're working from home. There's a lot of items that I think tend to pile up for people. They tend to put off, and we think that, given what's going on in the world right now, it's a great opportunity to look at a number of those items and really try and check those off your list. So Alex and I are going to talk through a number of those. Our goal for today, it's not to give any specific personalized investment advice. Instead, we want to speak to a number of items that you can really, again, accomplish while you're working from home or while you're at home. We want you to walk away with some actionable next steps that are going to put you in a better position financially than you were before this webinar. So to the extent that you have a pen and a paper available, to the extent that you have Microsoft Word open in another tab or anything along those lines, would encourage you to simply take some notes. If you do have any personalized questions, please feel free, reach out. You can always write them in the chat box, and we're happy to try and address them here towards the end. And we'll go from there. So again, we're going to try and keep things to about 20-25 minutes. We're probably going to sprinkle in a few additional items on top of what we've listed here, just some extra things we think are relevant. So anyway, let's just jump right into things. The main items that we want to talk about here today, first off, rebalancing and tax loss harvesting, particularly important given what we've seen in the markets. It's essentially an opportunity for us to turn lemons into lemonade. We're going to talk through emergency funds and emergency savings. We're going to talk through corporate benefits. I'm going to turn things over to Alex. He's going to talk through estate planning. And then Alex is also going to talk about gifting. So again, a number of items. We're not going to go too far in depth into each one of them, but we'll at least take a cursory look at each item and talk through at least some of the details and what you can be doing from home today. The first item that we have on here is rebalancing, and this is really one of the most important and one of the most action item oriented things that you can be doing within your portfolio today, particularly given what we've seen take place in the market over the course of 2020 year to date. So if we just look at a very quick dummy example right here, we're going to look at an overall allocation that's essentially 60% stock, 40% bonds. 60% stock, that's broken up between domestic, international, and emerging market stock, and then also fixed income. So we think of bonds, we think of a little bit of cash within the portfolio. Well, if you had this allocation on January 1st, 2020, over the course of the first, call it 2.5, 3 months of the year, we're just using indexes here, but I think this is a very good stand-in for what's taken place across the market. The S&P 500 is down 30% from January 1st through March 23rd. International, developed, and emerging market stocks are down 32 to 34%, and fixed income for all intents and purposes is flat. And so if this was your overall allocation on January 1st, all of a sudden, on March 23rd, your allocation was no longer the same. Your allocation was all of a sudden a lot more heavily weighted towards fixed income, a lot less heavily allocated towards stocks because stocks were beat up, fixed income was again essentially flat. And so what we want to do in situations like this is we want to take advantage of the volatility that we've seen, and we want to make sure that we are rebalancing the portfolio back to our original allocation. And how do we do this? Well, it's pretty straightforward. You can just say, well, if our target allocation is 40% bonds, 60% stocks, let's just bring the allocation back in line with where we want to see it. The reason that you do this is twofold. One, you want to make sure that the overall risk that you're taking in your portfolio is consistent. So you don't want to say, I'm going to have a 60% stock portfolio today and a 45% stock portfolio 2 months from now. You want to maintain that overall portfolio mix. And then at the same time, you want to force yourself to buy stocks when they're low and to sell bonds when they're high. So again, it forces you, this rebalancing process forces you to buy low and to sell high. So let's imagine that this portfolio that we're looking at right here, it started the year with $500,000 in it. Let's also assume that, again, we have two situations here. We either rebalance the portfolio or we don't. And then lastly, let's assume that at some point in the future, the market goes back to where it was on January 1st. And I'm not going to prognosticate. I don't have a crystal ball. I don't know if that's going to take place in 2 weeks, in 2 months, in 2 years. But I do have faith that inevitably we will get through this and the market will recover. So if we had rebalanced the portfolio all of a sudden, this portfolio that was less allocated to bonds, less allocated to stocks, we've put more into stocks so that when stocks do inevitably recover, that portfolio that was rebalanced now does not have 500,000 in it, our original 500. Instead, we've actually made about $18,825. Again, using rebalancing as an opportunity to turn lemons into lemonade. If we had not rebalanced the portfolio, we would not have as much oomph on the upside when stocks inevitably do recover, and our portfolio would be right back to where it was at the beginning. So using this same example, and actually let me take a brief moment. I'll go just a little more in depth here. When we think about rebalancing, there's a couple of ways that we can do this. Some people say, I'm going to rebalance every January 1st. I'm going to rebalance every July 1st. The approach that we really like to see is putting bands on that rebalance. So if your overall allocation target for stocks was 60%, maybe you put a 10% band on that, meaning that if your target was 60% stocks, if your stocks go up by 10% within your allocation from 60% to 66%, or if they go down from 60% to 54%, gives you a great opportunity to rebalance that portfolio back into where you want to see it. Again, if that's not your process, at least doing it once a year is a lot better than not doing anything at all. The next piece to touch on here is tax loss harvesting. And this is, again, just like rebalancing, something that we're doing with all of our clients where the opportunities present themselves. Tax loss harvesting, again, another great opportunity is to turn lemons into lemonade, is basically when part of your portfolio is down, we want to recognize that loss and use that to our advantage. So going back to the situation that we were just looking at, we start with $165,000 in US stock. Over the course of January 1st to March 23rd, that portfolio in stocks dropped from 165,000 down to 114,000. So we had losses. If we just focus right here on the US stock part of the portfolio, we had losses of $50,000. So what we can do is we can actually sell that underlying position as long as what we're talking about here is inside of a taxable account. So we think an individual brokerage account, a joint with rights of survivorship account, a community property account, a trust account. As long as we're talking about a taxable account, we can sell that position, immediately buy back a not exactly the same, but very similar position, and still maintain that overall allocation. And you'll see here, we replace it with a similar fund for at least 31 days. This is a little bit nuanced, but if we were to sell the same fund and then buy that exact same fund back within 30 days, we run into a wash sale rule. We're not able to recognize the losses like we want to. So we have to go into a substantially similar, but not exactly the same type of fund. And so if we do indeed recognize these losses, again, we want to make sure that we do maintain our portfolio allocation, because what we don't want to do is all of a sudden be out of the market for an extended period of time. If we just look this week alone, I want to say that the market's up about 13.5% just this week. So we don't want to be out of the market in cash. We want to still be invested. And what do? Well, we can, one, build it into our rebalance as a part of our rebalance process. And then with those losses that we've realized, we can offset any capital gains that we have. And then we can also use up to $3,000 a year to offset any sort of ordinary income that we have. And so as an example, what we're just looking at right here is the S&P 500. But if we also took into account international and emerging market holdings, we're probably looking at something like $80,000 in losses that we could recognize and utilize. And if we were to, let's just say that we had $20,000 of realized capital gains, well, those get completely wiped out with $80,000 in losses, and then we still have $60,000 in losses that we can work with. In that case, hypothetically, we could take $3,000 a year in losses, use it against ordinary income for 20 straight years. So again, we want to try and utilize as much as we can and take advantage of the volatility that we've seen in markets. Markets are down. There's nothing that we can do about that. But what we can do is, again, turn lemons into lemonade, make sure that we're taking advantage of everything that we can here. The next piece that I want to talk briefly about is an emergency fund. So what expenses should my emergency fund cover, and really how much should you have in emergency fund savings? First off, we like to see people with at least 6 months of non-discretionary expenses in their emergency fund. And the reason that we say 6 months is because if you are out of work today, Let's put it this way, the job market for the next 3 months does not look particularly good. And even if you go out a little further, the job market does not look particularly good given everything that's taken place in the world right now. And so we like to see folks with 6 months of expenses to cover non-discretionary expenses. That's going to include basic housing costs. It's going to include feeding you and your family. It's going to include healthcare. It's going to include utilities. One other item just to throw in here, when we look at housing costs, this is another item to be thinking about while you're working from home, another item for your action list. When we think about housing costs, we also think about insurance. And if you live in the Pacific Northwest, there's a really good chance that your home is worth a lot more today than it was worth 5 to 10 years ago. And so if you have a home insurance policy that covers an $800,000 home, but all of a sudden your home is now worth 1.2 million, you're underinsured. And so a great opportunity to call State Farm, call Allstate, call whoever you work with, and really check in on what sort of coverage you have for your home. On top of that, what about the belongings within your home? This is a great opportunity while you're working from home or while you're kind of locked up at home to really go through all of your belongings. And from an insurance perspective, what we recommend is taking out your iPhone, taking out your Android, literally recording a video of everything that you own in each respective room. And maybe that takes you 15 minutes per room. Maybe you just want to dedicate 1 day per room, and so you take care of it over the course of the next week or two. But really having proof of everything you own makes your life a lot easier. And then lastly, a really good opportunity to talk to somebody in mortgages, to look at your mortgage or whoever does your mortgage, and to really look at refinance opportunities. We've been looking recently, mortgage rates have dropped. They went up a little bit the last couple of weeks, but even since then, they've come down a little bit. We're working with clients today that they have a 30-year mortgage and they're 12 years into it, so they have 18 years left. We've been able to help them look at refinance opportunities. They've been able to move from what they have left of their 18 years left down to a 15-year mortgage at a lower rate that not only has taken 3 years off of their mortgage, but also has reduced their payment. And so again, a really good opportunity. Talk to your current lender, see if there are any opportunities to refinance. A really good thing to do these days as a kind of a checklist, bucket list item while you're working from home or while you're at home. What are things that your emergency fund should not cover? This is going to be things like entertainment, dining out, vacations. Clearly, if you had a vacation or any sort of concerts planned here for April, my guess is that's probably not taking place. We want to make sure that we have, again, just those basic expenses covered. And then just the easiest part of this whole thing, where should I invest my emergency fund? We don't like seeing emergency funds invested in stocks. We don't even really like seeing them invested in bonds. We want to see your emergency fund essentially in cash, in money market funds, or in high yield savings accounts. We don't want to see any volatility associated with that emergency fund. Particularly important that you have easy access to it and that it's particularly liquid. So with that said, I guess one other quick item here for you, corporate employee benefits. If you work for a large corporation, a really good opportunity to review your 401k. What are your contribution limits? How much are you putting in? Are you maxing out your 401k in 2020? Are you participating in any sort of ESPP, employee stock purchase plan, that's available to you? Are you taking advantage of the mega backdoor Roth conversion? So if you work for Microsoft, if you work for Amazon, if you work for Intel, if you work for a number of these local companies, there are some provisions within your 401k that are so spectacular that give you the ability to save so much above and beyond just your standard 401k. Certainly worth taking advantage of. And if you work for Amazon, your mega backdoor Roth conversion is different than if you work for Microsoft or if you work for Intel. So really something to look at. Again, it's the after-tax Roth conversion component within the 401k. If you have questions about it, please feel free to reach out, let us know. HSA, are you contributing to the HSA? Are these dollars that you don't plan on spending for a long time so they can be invested? Or are these dollars that you really do plan on using for healthcare expenses in the short term, in which case they should be much, much more conservatively invested, or they should just be sitting in cash? Company life insurance. Do you have adequate life insurance? Are you married? Do you have a family? Do you have kids that are going to college in the future? All important things to think about from a life insurance coverage perspective. And then also there's a number of companies that offer legal benefits for a particularly low cost. Typically it's a monthly fee or a monthly cost that you can pay out of your salary. Now, these typically are not what we would consider to be replacements for high quality estate planning or anything along those lines. But if you have a property line dispute with a neighbor, if you have, if you need to get out of a parking ticket or something like that, really good to have these benefits available to you. So check in on those. A great opportunity to do that while you're sitting at home. With that being said, I'm going to hand things over to Alex Krider. Alex is a lead advisor here in the firm, and he's going to talk a little bit more about estate planning. And then on top of that, he's going to talk about gifting and why right now gifting, it might be a particularly good opportunity to look at gifting. So Alex, let me turn things over to you here.
All right, wonderful. Thanks, Lars. Appreciate it. Yes, we're going to talk about some of the basic building blocks in every estate plan. And of course, that's going to start with having an up-to-date, and with emphasis on up-to-date, will. You're going to name your executor, your beneficiaries. And while we're talking about beneficiaries, they shouldn't just be up-to-date in your will, but make sure your life insurance and your retirement accounts all have up-to-date beneficiaries, contingent beneficiaries. Really important to have those all buttoned up. And you also want to make sure you have a guardian name for any minor children you might have. And a will is a great place to address any debt or tax issues. So a lot of times people ask us, well, is a will enough? Do I need a revocable trust, sometimes called a living trust? Well, a revocable trust is going to help to do a couple of things. It's going to help, one, avoid probate. Two, it's going to keep your estate out of the public record, and it's going to streamline the total estate transfer. And that's particularly valuable when someone has out-of-state real estate or a blended marriage or a closely held business. So if any of those apply, good idea to have a revocable trust. Now, a marital trust can be really valuable for folks in Oregon or Washington that have an estate tax that's really pretty low, just $1 million in Oregon, and in Washington, any assets above 2.2 million, you're going to be hit with a pretty good estate tax. Now, with the marital trust, you are in essence doubling that amount for you and your spouse. So if this applies to you, that your net worth plus life insurance, your total estate is over 2.2 million in Washington or over $1 million in Oregon, you should definitely consider a marital trust. Next, powers of attorney. Now these come in a lot of different flavors. There's a limited power of attorney, which has a very limited scope. This is if you're going off on a safari to Africa for 5 weeks or Australia and you want part of your affairs to be addressed. If you want someone to have all of your powers, that's a general power of attorney. A durable power of attorney is for someone who's incapacitated, and a springing power of attorney is for someone who at a later date becomes incapacitated. And finally, very relevant right now with the coronavirus is a healthcare directive, often called a living will. This is going to specify those actions that you want in the future. If you can't speak for yourself, do you want to be resuscitated? Do you want to be intubated and put on a respirator? What measures do you want healthcare providers to take on your behalf? So it might be a little counterintuitive, but 2020 is actually a great year to think about doing some gifting if your situation allows it. Every person has an ability to gift to another individual $15,000, and for a married couple, it's $30,000. And that's without any tax repercussions. You don't need to file any forms. Now, the question that we often get is it better to gift cash or stock? Well, gifting cash is simple and clean. It's easy. But this might be a terrific time to think about gifting some stock that has maybe been a little beaten up in markets over the last few months. We just have an example here of Boeing. a number of companies, of course, apply. Boeing at its peak a little over a year ago was at about 350. Now it dipped even at one point below 100, but it's now around 141. Now, if you wanted to gift some stock that has greatly depreciated here over the last couple of months, now it's a great way to maximize the benefit that you are giving to someone. So something to consider is, how do I go about gifting more and gifting a stock that's going to bounce back here in the near future? Now, if you're thinking, well, what if I want to gift more than that 15,000? Let's say you want to gift $115,000 of stock. Well, that first $15,000 is going to be covered by this year's exemption amount. The additional $100,000 will require that the gift giver file a Form 709 with the IRS, and that extra $100,000, that will be deducted from your individual lifetime exemption. So instead of having $11,580,000 to gift, that will be reduced by $100,000. Now keep in mind, a married couple, that's actually double. All right.
Beautiful. Well, Alex, thank you very much. I think we're running right up against our 25-minute kind of limit that we had set for people. We don't want to keep people too long, but below you can find all of our contact information. Here is my picture. There's my name, my email address. Please feel free to the extent that you want to reach out, talk to either Alex or myself or Dave or really anybody else at the firm. We're happy to be a resource for you. So if you're looking at a mortgage refinance and you want to run some numbers by us, please feel free, reach out. Our website, avieradvisors.com. Let us know how we can help. Let us be a resource. And thank you very, very much for joining us here on today's webinar. Much, much appreciated.
Thank you, everybody.
Bye-bye.